Uber stock has risen over 72% in the past year, and today we'll be looking at a clear market leader with great pricing power and why TipRanks gave this stock an 8 for outperform based on strong buy from analyst consensus, a bullish blogger sentiment, but decreased hedge fund trends. So today we'll be looking at Uber Technologies, a mobility company. In their annual report, they say that they're a technology platform that uses massive network and a lending technology to power movement from point A to point B. And basically, they have two main functions. The first one is that they can connect consumers with independent providers of ride services, which is their initial offering and what they actually became famous for, which is replacing taxis. And the second one is to connect other consumers with restaurants, groceries, and other stores, which is their Uber Eats platform. Now, they use the same network to connect shippers with carriers in the freight industry by booking shipments and other logistics services. Now, they believe that the vast amount of marketplace data that they gather means that they can innovate faster than competitors. So they have infinite amounts of data and they gather everything from where you're going, where you're coming from, at what time of the day you're ordering food, from where you're ordering food, and everything you can imagine, which allows them to actually personalize the services to each different customer. And then finally, they did a study where consumers who used delivery and mobility, that is the normal Uber and Uber Eats apps, generated 10.9 overall trips from both platforms on average, whereas if you only have Uber or you only have Uber Eats, they only generated 4.6 trips. Now, when looking at their financial analysis, we do have to consider their Uber. I believe this is their first year being actually profitable, and they have been burning cash for a long time, because they wanted to grow at a massive scale before actually becoming profitable, and that is why some of these ratios look scarily low. For example, their return on capital employed is a 7%, which is way below the threshold that we usually look for, which is 15%, but this is because they have a very small profit for now. They're growing this at impressive rates, and that's why their stock has skyrocketed over the past year. Then they have a very low interest coverage ratio at 4 times, which means that it is possible that they will have to worry about short-term debt at some point, but it is not likely. Then they have a very good cash conversion of 132%, a solid profit margin of 31%, but a pretty small operating margin of 7%. Again, for the same reason that their return on capital employed is so low. And here we can see exactly what I was saying. So we can see that the revenue and gross profit have been growing every single quarter, and we can see that the revenue went from around 20 billion all the way up to close to 40 billion in only 2 years, so it doubled. However, we can see that their net income, they were burning cash all throughout 2022, and now they've actually become profitable. And although it's a very small margin, they're not focusing on that. They're focusing on improving their top line, aka their revenue. So there will be a point in the future where this company will start to focus on, instead of growing revenue, started to expand their margins. And that is when their net income growth will kick in, or that is at least what I believe. Now, in terms of efficiency ratios, they have been all over the place, and they're now starting to become a lot more stable since they are actually becoming profitable. But we can't judge this since it's still a very new firm in terms of profitability. Now, Uber has a very nice current ratio, and I like the fact that they have been able to keep their total assets above their total liabilities for such a long time. Now, when we look at their fundamental analysis, this gets a 7 out of 8. And the fact is that they have sort of low liability risk. This wouldn't be a full tick, it would be like a half tick, because we saw that their interest coverage ratio was a 4 times. However, since they have very predictable and very stable revenues, I believe that they have low liability risk. Now, they have a very solid balance sheet as they can cover all their short-term liabilities with their short-term assets, and they are very good at generating consistent cash flows. Now, they're able to grow their revenue at a very high organic rate, and this allows them to actually grow their free cash flow at, again, a very high organic rate. And now the thing that I love about this company is that they have an insane amount of pricing power, and they have a very large existing moat / competitive advantage. As we saw, members who use both platforms, Uber and Uber Eats, are likely to use the apps a lot more than those consumers who only use one part of the app. And whenever you are in Uber, they have such a good reward system, such good service that you're not likely to change onto another platform. And in fact, the other ride-hailing platforms or the other Uber Eats competitors, they don't have a unified platform. That means that you will have to go to one for ordering food and to another one for ordering a cab, which means that Uber has the perfect combination of platforms. Now, the one thing that only gets across is that, of course, they don't pay a dividend. They're reinvesting back everything that they make. However, they do not have any share buyback programs. I think that they're actually selling stock at these prices, which is not the best for the investor. Now, however, when looking at their valuation analysis, we can see that before September 2023, they have no ratios, and this is because they were at negative earnings, meaning that the PE ratio cannot be calculated. And since their profits are so low, I wouldn't check the price to earnings ratio in order to see whether this company is fairly valued. Instead, I would use the free cash flow yield, which they yield a 2.32%, which is a bit lower than the long-term inflation rate of 3%, meaning that this stock is a bit expensive right now at the current valuation. And where I see the risk and possible challenges are, first of all, the worsening competitive landscape, since they're so profitable and it's such a good sector or industry to get into. There are so many competitors which are backed by huge funds and they have a lot of money to compete against Uber, and this is only getting worse, forcing Uber to not afford to make any mistakes, as anything could actually lead to other competitors stepping up and grabbing some market share away from them. However, Uber is the clear market leader, and I expect them to be the clear market leader for the years to come. Now, any possible upcoming regulatory changes, I don't see anything hurting Uber. The only thing is that they're trying to move towards their Uber platform being 100% driven by autonomous vehicles. And this is where I see the issues with regulation changes, where it won't be so easy to actually get that under control. I don't see them not meeting any performance objectives, so this was a 20%. And then in terms of an economic downturn or cyclicality risk, I do believe that people will start to, for example, order less food to their houses and take less Ubers to go to places, and instead take, for example, public transport or other more affordable types of transport. However, I do believe that this is a very minor risk and that Uber is pretty solid for the long term. And now, before moving on to the investment conclusion, please remember, I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that Uber has a very strong competitive advantage. They're able to produce consistent and predictable and, most importantly, growing cash flows. However, they do not have a high return on capital employed yet, so I do not believe that they're creating value for the investor yet. I do believe that this return on capital employed will increase in the future, but it is not there yet. So I do believe that this is a very good company and that it will very likely be a great investment. However, it is trading at a very high valuation, and any misses in any of their earnings could make this stock drop a bit. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.